Hey guys, Ben Nash from Pivot Wealth here, and today I'm pumped to be here with Nick Nicolaides. He's the co-founder and CEO at Perla, who, if you've been hiding under a rock, Perla are an investment app. They help people essentially create financial independence, and I love what they're about in that they've got a lot of crossover with their philosophies around investing should be a little bit boring, and get rich slow is more effective than get rich fast. So keen to unpack some of those philosophies as well as talk about some of the insights from their pretty massive community of investors. Nick, thanks for joining us, buddy.
Thanks, Ben. Thanks for having me.
Mate, it's I'm keen to pick your brain, especially someone that sees the data come through around investors, what people are doing in the market at the moment. I speak to a lot of people, and I think it's probably across all society, but I think for younger investors in particular, there's a lot of questions about like how do they compare, how do they stack up, and where should they be at different points and in their investing journey. So I'm keen to get into that, but I thought maybe a good place to start was really just talking about like, what's your take on where the markets are at the moment? Obviously, we've seen a lot of crazy ups and downs. I'm just looking at the market. This week, the last couple of weeks, also Russia, all of the stuff from this year. What's your view?
Well, I mean, my view is that life goes on, and certainly lots of chatter around tech announcements and prices being down, etc. But my view is that none of these things have changed necessarily your personal situation since 6 months ago. And so I think the way I try and approach these things is kind of question, despite all this news in the world, has it really changed my situation? My mortgage rates might be changing, but is there anything else that's really changing? And so when you step back and ask yourself that question, I think you find that there's not too much to worry about. What can you do?
That's true. And I think time de-risks all risk. I know when you look at a lot of those, if you can, and obviously you can take this a long way if you look at the different analyses that are out there and, all sorts of charting and those sorts of things. But the longer you're investing for, all of that stuff matters less and less and less, to the point that it doesn't really matter at all. And I think for a big part of your community, as well as a lot of, people that we talk to, you've got 10 years, 20 years, 30 years to invest. So trying to pick the ideal spots and avoid the less ideal spots is impossible to do. So when the alternative is doing nothing, then doing something is certainly better. And, those dividend checks keep rolling in. So, probably beating getting a 0.25% in a bank account as well.
Yeah. I mean, maybe as a society or as a community, perhaps a lot of us have come beyond that whole idea of your money's the safest in the bank. But now it sort of opens new questions, right, around, well, what's happening with the market in general? And then all that does is bring you to the question, well, how diversified are you and how long can you hold for? And they're the big questions always.
That's right. Yeah. And it's sort, and with share investing, and I've mentioned this on other episodes of the podcast, it's like the suggested investment time frame is 7 to 10 years or more, because the market might tank and you might need to wait that amount of time to get a positive return. But you don't have to want to wait that long. And if you invested a couple of years ago into the market and your shares were right up now, you can sell out. You don't have to wait until year 7 to cash out or anything. And I think that question is like not so much how long do you want to wait, but how long can you wait, to your point, to get the returns that you want. And oftentimes that is a long time.
Yeah, I think life's going to happen, so you never know. But I think the way we see our investors setting themselves up for success, and we see this in the platform where people are setting goals, right? So the average goal is sort of 12 to 15 years, and that might be a home deposit or it might just be financial independence. But no one really knows what's going to happen in 3, 5, 7 years, not so much with the market, but with you and your personal situation. So I think the message we come back to is, as long as you go in with eyes wide open and you have a fairly strong idea that you're in it for the long haul, then you can better deal with the things that come up in life. And that's what's most important, rather than stressing every day.
Totally. And also for younger people in particular, that, we have measures around how people's incomes grow over time. But when you're earlier on in your career and you're building that career up, that you tend to overachieve when it comes to growing your income over time, which means that you're going to have more options and more opportunities in the future. So your question is, should I not invest for the next 12 months and wait, as opposed to invest knowing that if the market falls off a cliff in 12 months, which is always possible, that you might need to leave it in there, you can still have the opportunity to pivot and then still do stuff. It's not like your life's going to end because you've left $10,000 or $20,000 or $50,000 in an investment until you get the returns that you want.
Yeah, I mean, in terms of finance, media, and a lot of the education, we've got to remember it's meant to be a one-size-fits-all message, which just isn't right. So a lot of the messaging we all hear is speaking as if we're all investing this giant lump sum and then leaving it there to grow. But the reality is, Perla has customers that are 19 years old through to 50, 60 years old. And that is, for them, a process of investing every month or every fortnight, right? So once you disconnect the idea of investing as this one-off thing you do, this scary one-off thing you do, from a thing you should do every month or so, then it becomes a bit easier to kind of understand, well, I'm investing maybe now and a little bit in the future and a little bit in the future. The market goes down or up, but I'm still investing, rather than I've put my entire life savings into something and it might go down next month, which just isn't the case for most people.
Absolutely. Yeah. And I think one of the things that journos sometimes get a bit frustrated with when they talk to me is that they're trying to pin me down on, like, how much should people be saving, or how much should people, like, what percentage of your salary do you need to invest to be financially independent? And that's different for everybody. Like, everybody's situation is different. What everyone wants their future to look like is a bit different as well. So sometimes 5% is enough. Sometimes 50% is not enough. It just really depends on you and where you're at and what it is that you're looking to do. So while it's interesting to compare against other people, and yes, there are some broad principles and philosophies that make sense for a lot of people, there is, unfortunately, for everybody listening, and for us as well, like, there's no one set of steps that every person can take to end up being financially successful. It's about what's right for you. But Nick, one of the things you touched on there is you were talking about some of the insights from your community. What are some of the trends that you're seeing from Perla users and investors?
Yeah, so I think before I jump into that, it probably is good just to touch on what the community looks like, what some of the key cohorts are. So, I mean, overwhelmingly, people using Perla are investing in ETFs and shares, but they're mainly investing in ETFs. So about 70% of the average portfolio is in ETFs, and then the balance is sort of split between a few Aussie stocks and a few US stocks. So that's sort of the group we're talking about. The other things to note are they are sort of predominantly just buying. So 90% of the transactions are buys versus sells. So it's really regular behavior. It's not trying to take quick wins. Mm-hmm. They're just two really important things to note, because not everyone wants to invest like that. And obviously there are other apps where the behavior won't be like that at all, right? So then if we dig deeper into that, and the big question on most of our investors' minds and the people out there in the world trying to make sense of investing is, what do I invest in? And it's different. In a way, it's different for everybody, but there are certain things that have happened, for instance, with ETFs that have made it a whole lot simpler, right? So what we're seeing is, whether someone, there are a couple of key cohorts, right? 19 to 20 odd, 25 to 35, and then 35 and up. And there's one thing that sort of is kept fairly constant across that community, right? It's investing in very, very cheap, broad index funds. Nothing too exciting, to be honest. So I don't know whether I can mention specific securities, but let's just say, the A200 and A300 indexes, the total US share market, the S&P 500, and then the all world index, those couple of indexes would be the top 5 holdings within the community. And not everyone will have all of those. They overlap, of course. But within that group, you could effectively have 1 or 2 shares in your portfolio and have a very, very simplistic investing strategy. So where it becomes more personalized is what you do with the other part of your portfolio. But as a start, that's one thing we're seeing with the people using Perla, is that focus on simple, cheap, serve a purpose.
I'd say that's pretty exciting. It's maybe not in the sense that some people look for, excitement when they invest, but making money is exciting to me. And I think if you want entertainment, go play video games. If you want to make money, sometimes stick to the fundamentals, and that can be the most effective one. And I love that the stats around most of the trades being buys, because you only ever really lose on an investment when you sell it. And in my view, the more that you're selling, the more chances you're giving yourself to end up losing money. And no one, even the professional investors, get it wrong more often than they get it right. So if you're sitting there at home, trying to outdo the market, you're potentially going to run into trouble. Certainly that's been my experience from talking to a lot of people that have gone down that path as well. So I think that makes a lot of sense. Is there any interesting stats around, wealth levels, or like how much people have in their portfolios in those different cohorts, or how much they're actually investing regularly as well?
Yeah. So on the average, right, and this is across quite a broad cohort of people, the average portfolio is in the sort of 10 to 30 grand bracket, right? But that is skewed by some older investors, right? What I think is probably most interesting is that most people start with $1,000 to $2,000, and what we see is that's kind of the average starting point. But what's really interesting is that it doesn't stop there. So the average sort of investor in the Perla universe, anyway, is they'll start with 1 or 2 grand, and by 6 months in, they will be at about 4 to 5 grand. So the behavior is very much get your portfolio started and then invest $1,000 to $2,000 a month. There's people investing $500 a month. There's people investing more, right? But the behavior very much is keep building that little portfolio. And eventually, when they're a year in, 2 years in, that's when they're getting up to that average, 5 to 10 grand and then more. That's pretty consistent. That behavior is consistent. The number might change, but the behavior is pretty consistent. I think that's what's really interesting. It's not around putting an amount of money in and then playing with it. It's around continually adding. And if you look at your portfolio, or if you look at your net wealth that grows over time, certainly in the short to medium term, the biggest things that are going to drive the value of that portfolio up are not the market. It's going to be the frequency and how much you can put in there, right? And that's the exciting thing. When you see that start to step up, that's what really gives you that positive reinforcement, helps you do more.
Totally. Yeah, it's all about motivating yourself, because, being successful with your money often means that you're putting money that you could spend today away for tomorrow. And it's hard, especially for younger people, to even a lot of psychology, like studies and stuff, that show that it's hard for us to identify with ourselves in the future. So you've got to be motivated. That's why I think it's great. And I love that you guys have got your goals and targets built in, that you go, okay, this is what I'm working towards. And then you can see your progress and go, great, like let's celebrate those wins and let's keep at it, because that's what's going to lead to results. And I think what I've found with a lot of investors is that they overestimate how much they can do in the short term, and they underestimate how much they can do in the long term. And if you're overestimating how much you should be able to do in the short term, it's like you try to do some stuff, you get frustrated because you're not getting as much of a result as you want, and then you get distracted and you're like, why am I doing this? And then you get off track and you don't follow it through. But then they underestimate how much can be done in the long term. And often when we'll do an example and just get a basic compound interest calculator and go, $50 a week, and it makes you $1 million over X amount of years. And people are like, wow, that's amazing. But you've got to follow it through to get there. And that consistency is the key. So the more you can hack your thinking, keep yourself motivated to get through those early stages, then you start racking up some wins, and then you're more motivation, and it turns into a self-fulfilling prophecy. It just keeps going and going and
Yeah, and
going.
look, we're all in the same boat here, I think, because no one is somehow immune from the emotion of seeing something go up or down, right? But it's also not our fault, because I think that technology around investing and investing apps is typically lands you on this page, and the first thing you see is, well, is my portfolio up or down today? When what it's not showing you, for instance, is the fact that for the last 6 months you've put $500 aside a fortnight, and your portfolio balance has stepped up really nicely. You look at that graph and you go, wow, look at the positive impact I'm having on my life, versus you look at a red number, and of course your reaction, it's not your fault, your reaction is going to be negative. So that's all part of this journey we're on as an app, to go, okay, how do we reset or rewrite the rules of what that investing experience is and what's it all about?
Totally. And I think it's like you see, and property is something that Aussies are quite hooked on as well, that and the property market's, facing a few wobbles at the moment, that people go, oh, the property market's down by 0.2%, and wow, it's on the way down. But you think that on $1 million property, that equates to like $2,000 that you've lost after you just made 250K in the last year off the 25% price rises that we saw. But people go, oh shit, that's a major problem that I need to address. You think about it in your $10,000 or $50,000 or $100,000 share portfolio, a 10% drop in the market, it's we're not talking about big dollars at the end of the day as well. So I think it's, headlines get attention and clicks and those sorts of things, but like, what is the actual impact to investors? Interesting though, that what you're saying about the behaviors and the typical approach for people when they come onto the platform. I'm interested in, maybe I'm putting you on the spot and you might not know these numbers, but you mentioned those different cohorts. So like the sub 25s, 25 to 35, 35 plus. Do you see different behaviors in terms of the wealth levels or how they tackle things with their journey? Or is it reasonably consistent even across those different cohorts?
Yeah, look, and the answer is it's reasonably consistent. And it's obviously the numbers are different, right? People earning that 150 grand and up level are investing more. But you mentioned earlier around the percentages and how much should I save and whatnot. One thing that's quite interesting is, on average, people are investing about 10% of their post-tax income, and that's reasonably consistent between men and women. Although we do find that there's a few differences, obviously, between men and women. What we track around those sorts of metrics, things like earnings. So, what we've found is there's probably a higher skew towards women who are younger earning less than men, and they are investing at the same rate though. So what we're finding is
Sensible.
yeah, right. So and this is just from our data, right? So this isn't speaking to some broader thing, although I think, gender wage gaps are well covered. Probably a 30% wage gap. However, no real difference in the frequency of investing. So still sticking to that once a month, thereabouts, frequency or cadence. And I think that's one of the good things that not just Perla, a lot of the apps have made accessible, is the idea that this doesn't cost you the earth. You don't have to save up every 6 months to dump the money in. It's more about the habit.
Totally. Yeah, and I think that like one of the things that I talk about when we give our presentations around investing and investments is that like there are different cost differentials between the different apps, platforms, and solutions that are out there. There are differences between companies where you just like an online broker versus micro investing versus whatever, but especially when you're earlier on and getting started, the actual differences from an investment return perspective or what your portfolio is going to do they're again very much at the margin. So I think that one of the things that we say is like you find a solution that you're aligned from a philosophy perspective, that they offer the investments that you want to invest in. And I think it's really important that you figure out how you want to invest before you figure out what is the right platform to get there. And then you find something with a good user experience that's nice and easy for you to use, that is as frictionless as possible, so that you can just make it happen easily. Because the more you have to do, the less likely you are to do it. So
Yeah.
I think those are the things. Taking more action makes a much bigger difference than eking out a different, the capital gains tax differential between a managed fund and an ETF. Like, yes, there is a difference, and yes, one, if you've got $10 million, one's going to be better than the other. But if you got $10,000, like, is it? Like, probably not. So
It's all a matter of what you want to spend your time on, right? And I think, definitely we're fairly active in social media and whatnot, so we get a lot of direct questions. And it's certainly a topic, because there are a lot of apps out there, right? So it's certainly a topic. What app should I use? Which one's best for me? And not necessarily in my best interest to say so, but at the end of the day, these apps are all free to open up. There's no minimum, so why not try a few? You don't need to needlessly have 10 apps on your phone, but there's nothing stopping you from trying and seeing which one suits you. There's nuances, but there's also a lot of similarities. The difference becomes, though, when you get to that whole, am I suited to share investing? Is my income suited to share investing? Is my temperament suited to share investing? Or am I more suited to a simplified micro investing experience? I think that's a probably more fundamental question that people ask. And people probably have preconceived ideas, or I need to invest in shares because that's more sophisticated or whatnot. But at the end of the day, these products have evolved now where there's great share products, there's great micro products, and they're all reasonably priced. So it really comes down to, well, what's going to help you be best, or what's going to help you not check your app as much if that's a problem for you.
yeah.
And that's a big problem for a lot of people.
And also, I think that and I think that both of those solutions have their place, but I think that where micro investing or app based like platforms tend to win is that when you're buying an ETF on an online brokerage platform, you've got to put your money in, you got to wait for it to get in there, then you got to go in there, you got to pick your ETF, you got to find the price, you got to choose, do I invest at the market, do I invest a limit? If I invest at a limit, what limit do I put? Is now the right time? Should I wait till 2 p.m? Should I wait till 4 p.m? Is the price going to be different? And then you go, shit, now I got caught up on that phone call, and then I didn't make the trade, and now bloody hell, and then that can happen again tomorrow. So with the apps where you just go, okay, well, here's my regular transfer, or here's draw it out from here, put it into this thing that I've set. It happens without you having to think about it, which means that it happens easier and more consistently. And as I was saying before, consistency is a big part of success, I think, with this stuff as well. So like I say, both have their place for sure, but definitely wins on that ease of use piece, which I think is a big one for especially time poor people that don't have really deep investment knowledge or interest or time to be sitting on a platform, trying to figure it all out for themselves.
Well, a few years ago when we came up with the original kind of spec for Perla, the idea of share investing together with automation was really at the core. And so, we've been in the market now for a little while, and to date, I think we've got about 40 to 45% of our investors using auto invest. And so what that does is it allows them to build their little portfolio of shares and then set a schedule. And it does all those things you mentioned, with the exception of, having to break at lunch and log into your brokerage app and buy that ETF price and whatnot. So it's automation. Automation for us is the key, I think, to lowering some of the emotional barriers to investing. There are lots of ways to lower the barriers. One's cost, one's diversification, one's education, etc. But we don't look enough as an industry at the behavioral side. And so if if we're out there automating our bills, we're out there automating the good things in life, like our, Netflix and whatnot, that give us some joy. Why aren't we also, subscribing, if you will, to this whole investing thing? And that's why separate to shares, the micro industry has done a great job in kind of building out that product.
Yeah, I think it's our inner investor is a bad investor when it comes to psychology. And I really geek out on the behavioral finance piece. And it is so difficult to escape that when you're about to click the button. It's like you can't help but think, oh, what if I just wait? And what if I just wait and think, or is it the right time? Or what if I come back tomorrow? Like it's really hard. So the more you can get out of your own way with that, I think the better the results. Nick, what trends you mentioned just when we were chatting a bit offline about ESG investing, which we're seeing a huge amount of interest and growth in as a part of the investment landscape. Are there any sort of interesting trends that you're seeing from your community around ESG?
Yes. So, I mean, obviously it's topical and it's got a place in our platform. It's obviously community led. So we do get to see ultimately who's investing in ESG versus not. And so there's some interesting things there. Our holdings of the platform in general, so not taking into account ESG, are, probably 50-50 Aussie to international on a spread. Mostly through the ASX though, right? Through ETFs. The interesting thing when it comes to ESG is it seems to be a topic that hits much closer to home. So the most popular global ETFs will be in the top 5, right? But when it comes to ESG, I think 3 of the top 5 are Aussie-focused ESG ETFs. So that's an interesting thing because, it's not going to have the tech, NASDAQ tech companies and whatever in it. It's much more of a localized thing. And even to the extent of, it's a couple of ETFs that are probably a step away from that pure index type approach that have been launched recently, a little bit more active or a little bit more positive filters as opposed to just negative filters. And we're seeing a lot of people request those as well. So I guess what that's saying is, and maybe not surprisingly, when people are thinking of that ESG lens, they're being motivated maybe by their direct environment or their children or something around their lives, and that's translating into when they're investing in Aussie companies, they want to be investing in, they don't want to be investing in companies that they see to be destroying our local environment. That's the first thing. I don't know if that gives you any insight there.
Look, I think it makes a lot of sense that, when people invest, with ESG, that it is because they want to have a positive impact or they don't want to have a negative impact on the world. And, obviously our world here is closer. That people tend to you care about the whole world, but your backyard is your backyard. So, I think that does make a lot of sense. And I think the ESG space is something super interesting. We've been advising people there for years, but wind back 2, 3, 4, 5 years ago, there really wasn't anywhere near the choice that people have now. And a lot of the products, they used to be pretty average in that, it was almost unethical. I think when you look at how much they're charging for what they're actually doing, and I'm looking at this going, it's almost, there are a couple in particular where it's they're profiteering on that desire of people to invest in a socially responsible way. Thankfully, that is changing, and as more people come into the market, those players have had to adjust what they're doing. But I think it is still really hard to find quality positive screen products that deliver as well. So I'm really excited by the fact that we are seeing more of those, and I'm hopeful that we get more choice there that can allow people to find, what fits with their value set, which is really different for everybody.
Yeah, and I think it's evolving to the idea that just by investing in ESG is probably not going to tick all your boxes, because you will never find this perfect ESG index that doesn't have a company where you as a person, you as an individual go, how does that fit in, right? So I think the other thing we're seeing is with someone who's more focused on ESG, they probably have a higher percentage of direct stocks too. So that's a way of being like your own positive screen towards companies you believe are actually good for the world. And so that's pretty interesting, because I think what that's showing is it's pretty quick uptake, right? In terms of, I'm going to have bulk of my portfolio with some negative screens and some positive screens, right? But I'm then going to go a step further, and I'm going to, for instance, invest with companies that hit on some environmental or cultural thing that I'm interested in. And that's not just the world around us. That's things like demographics of leadership, etc. That we definitely see those as themes more and more. And I think the last thing, there's really only one other sort of data outlier, is that if we look at all of our ESG ETFs, our community is fairly evenly split, men and women. When it comes to the ESG ETFs, we offer them all, right? But the split there is probably closer to 70% women to men. So whatever's happening there, yeah.
Very interesting. I wouldn't have thought that it would be such a big variance on that side, but yeah. Come on, fellas, what are you doing? That's amazing.
And look, it's not something that we necessarily look at and go, oh, we have all the answers as to why, but we do talk to customers all the time. I think it's probably a combination of, yes, there's some marketing involved at a time where people are learning more about this sort of stuff. But I also think, from the direct examples we've been given from customers, I think, there's more of a conscious decision around the future of families and whatnot. Now, I don't know why that's not so much of a trigger for men. I can't speak to that at all, but certainly in the small sample size that we work with, that's definitely a theme that comes through pretty strongly.
It's interesting. Could also be that potentially males, who I found are a little bit more DIY than females when it comes to investing, financial planning as well, that they perhaps are still doing it. Maybe the difference isn't that big from who is actually investing in ESG type investments, but perhaps they're just doing it on a different channel potentially as well. So but it is super interesting to see. It's and obviously a huge growth space, I think, for the future. So it'd be interesting to see how that changes as we're seeing more come onto the market there.
Yep.
Nick, you talked us a lot about like the stats and the community, but tell us a bit about the Perla story and how it sort of came about. What led you to go down this path?
Yeah, sure. So I think, I mentioned earlier when we first started building our platform, we had a very simple idea: Aussie shares, automatable. But there was a lot of work that went into, well, how do we deliver that and how do we grow that concept? So, that started probably a couple of years ago. I was working in, what's called a family office. And so, that's a special purpose investment house to manage the wealth of one particular family. And that was all about investing, right? Or I thought it was. When I got there, I figured that actually this office was more about family planning, goal setting, succession. It was also about sharing information. So all these wealthy families getting together, sharing intel, everything from lawyers to plans to investments, the whole bit. That's what really clicked for us at Perla. And we thought, well, everyone's out there floating around, reading all this research, having all these apps thrown in their face and all these investment options, but the conversation about money is really challenging. So we brought that idea of community, data, openness together with just simplified, automatable investing, and that was our MVP. So we set out to build that, and a lot of trial and error and a lot of research, working with a lot of people in your industry, talking to them about what the experience, what the perfect experience for a share investor could be. And that's where we got to early 2021. And since then we've we've started working with content creators to try and spread the message of passive investing. We've added on US shares. We've added on the net wealth dashboard that allows you to link in your bank accounts, your mortgage, etc., so you can start to get a holistic view of your wealth. And we recently launched a managed fund product, like a Perla micro product. So that's the short history. But I think the thing that keeps coming up for Perla is, and what we want to keep trying to achieve is, how do we bring simplicity and automation together with this idea of community and sharing information, and how do those two things come together to maybe solve some of the age-old problems of finance, cost barriers, access to advice, imposter syndrome. I don't know, that's a bit of a jumping around story, but that brings us to today, and that brings us to that community I've been talking about on this chat, which is long-term thinking ETF investors just doing simple things over and over again.
Well, I know that you've downloaded some of your thoughts around some of the things that you've got on the roadmap around that, and I think that's great. I think there is so much noise out there in this space and a lot of the noise, the stuff that's most sort of gets the most attention is often the things that are inconsistent with some of those real fundamental, foundational, effective things when it comes to investing. So I think having like-minded people that are sharing their successes and a philosophy, I think that makes a lot of sense when the philosophy is a good one, like what you guys are about. So it's great to see. What were there any big surprises for you on the way in terms of what people wanted or what people valued, or obviously you as you're building your product, you're thinking about what do people need, what do people want, what are they going to use, what are they going to not use? Was there anything, I obviously didn't give you any warning on this question, but was there anything that surprised you on the way?
So I think when we started, we had a very strong focus on, probably more of a mid-career sort of person. So, I'm in my 30s, and, for a lot of, and I've always been in finance, but a lot of my friends haven't been. So in a way, I was sort of led by that idea of creating something that someone who was earning a little bit of money, wanted to simplify, could use. I think one of the big surprises that we found was that whilst we started there and started with some bloggers active in that space, more lifestyle bloggers, really quickly saw a very young person uptake as well. So we never really thought, and there's so many apps out there, and they're all trying to go young, exciting, get into the market, all this sort of stuff, which when I was in my early 20s would have excited me too. And I had stodgy old ComSec when I was in my 20s, right? So we just never thought that we would resonate with that younger audience either. And so that's been a really big thing that we just didn't expect. But I think then when that happens, the even bigger surprise is that the young people on the platform are investing in largely the same way as the older people on the platform. And we're not a massive business yet. 50,000 people have downloaded the app. But what's connecting them all is that mentality. And so our job as a business, and where we've got to go, is we've got to go and figure out, okay, how do we tap into different age groups, different demographics that all have that mentality of, I want to simplify, I want to get ahead. I'm not trying to beat the market. I'm not trying to prove I'm the smartest. I just want to be smart,
Yeah. Well, I think that message is coming more into the investment dialogue, and more people are coming to that realization. I know when we're talking about index funds a decade ago, people are it didn't have the same level of popularity that it does have today. So it seems that people are understanding more, a little bit fewer conflicts in the market. So yeah, I'm excited to see that message grow. But Nick, look, thank you so much for sharing your story and your insights. Really appreciate it. For people that are keen to learn more about Perla and what you guys are about, what's the best way for them to learn?
Sure, perla.com is a good place to start. And if you want a bit of a more casual intro into what we're all about, we post some pretty nerdy finance stuff on our socials, which you can find at Perla HQ on your Instagrams and whatnot.
Nice one. Cool, guys. Well, thank you again for sharing your story. Really appreciate it. And yeah, we'll catch you next time.
Thanks, Ben. Thanks, everyone.